This episode is sponsored by Property Filter. Find great deals faster.
Hello and welcome to the Financial Freedom Podcast, sponsored by us at Property Portfolio Building. This podcast is designed by real people on their journey to achieving financial freedom, and we'll focus on people who've either already attained it, who are joining us on that journey, or maybe a specialist topic that can help you build your technical knowledge to achieving and maintaining that financial freedom. We hope you enjoy it. Hi folks, and welcome back to the Financial Freedom Podcast. Today's episode is one of our technical episodes, but we're also going to wrap it up with one of our 6 rounds with. We're going to actually be talking about asset classes and those that we see people investing in to achieve their financial freedom. Most of our chat is boring property talk, right? So
it is definitely not boring. We do focus a lot on properties.
Yeah, no, it isn't boring, definitely not. But there are other things that you can do. So we're going to talk about a bit more of a well-rounded view on all of those things. With me as always is Tim. Hello again, Tim.
Back. 6 rounds of assets.
6 rounds of assets. So we're just going to do this quick fire questions, and you're going to just give a bit of your opinion and experience in that.
Yeah, opinion on, do some pros and cons of each maybe is probably a good way to.
Yeah, it's lovely. All right then. So asset class number 1 we'll discuss index-linked stocks and shares.
Yeah, so they could be called index funds or tracker funds, I suppose, can't they?
Yeah.
So basically what that is, if you took some examples, so in the UK we got the FTSE 100.
Yep.
And that's I think the top 100 companies in the UK, and they listed companies in the UK, should say. And it tracks their performance in essence. S&P 500, which is the American one, is the top 500 listed companies in America.
Yep.
So the main benefit for these is that you're investing diversely. Because like S&P 500, you're investing across 500 companies.
Yeah.
So it can't go bust.
Yeah.
Because company drops out, another one comes in, etc.
Yeah.
So you've got
it's the 500 top performing listed companies.
Yeah, you got that diversity, and they're the top performing. So generally, over time, it's going to go on an upward trend. So there's some big advantage there. And if you and there's a little amount of work that you need to do. So you literally go S&P 500. You could just put like a direct debit in every month, just keep investing always over time, and it'll just keep compounding. Obviously, there are times it goes down, like at the moment. We've had Trump's...
Right, so we're in April 25.
April 25, and Trump's
tariffs.
is introduced some fairly hefty tariffs on a lot of the world.
Threatened China with 104%.
So as an example, this like the S&P 500 has come down quite substantially in the last month or so.
About 20%.
About 20% or thereabouts.
Which
is... Yesterday, I think, was like one of the biggest drops since COVID, as an example. So yeah, obviously they can come down with things like that. Yeah. But then generally they recover if you're investing for the long term.
Yeah.
Year in year
out. And this isn't just for investors either. The index linked funds are very much large portions of pensions.
Yes.
And so on and so forth.
Very true.
Because it's seen as a reasonably stable stock. So when something drops 20% in a month.
Yeah.
That is for something that normally doesn't.
So that's another pro, is it's like you're getting decent returns, but it's relatively stable. So like I think on average the S&P 500 goes up, I don't know, 8 to 10% or something like that historically. You might have some years like, where it goes down, other years where it goes up a lot, but in the long term, that's what happens.
Yeah.
So what could be some of the cons is like some people's expectations of returns are really high. So you're not going to get those 30, 40, 50, 100% returns. You're just not going to get that index fund unless you were trading or you did it in the short term.
It does compound though.
Yeah, it does compound obviously. So if you're getting, use a compound calculator to work this out. But if you got 10% gains over say 20 years, it keeps compounding and adding, and you're reinvesting, aren't you? So it just builds like a snowball over time is the terminology. But on a general per year basis, you're talking like 8 to 10% returns or 7 to 10% or something like that, aren't you? You're not getting your crazy 100% returns every year or 50 or whatever. And I'm trying to think any other cons you think of an index fund.
It's obviously the main con of any of these types of things is you put your money into something that you are not technically in control of.
You don't have control. Yeah, the idea is you put it there, it's quite passive, and you just want it to compound over time. I think the people who perform best out of it historically in the index fund market is people that forget that it's there.
Yeah.
And that's why it does so well, because they just leave it, forget it's there, and it just keeps going up and compounding over time. Because it completely takes away any human emotion to it, because that's the best way to do it. Just keep it there and keep it compounding over time.
Yeah. Good. Yeah. No.
So number 2, asset class number 2, as I'll flick it back to you, is stocks and shares, but individual company shares.
Yeah. So Very, very much. This depends on the scale of what you're doing as well. So you can either get in very, very early into a company's life cycle, or you can join a later part if a company lists. So normally what happens is a company that's just setting up, if they're willing to give away a portion of their business, they'll operate an angel type investor share scheme. And there might be some good pros with that. So a lot of it's protected. If you invest in companies in the UK, as an example, the UK government has a EIS and SEIS scheme, which SEIS is for very early investors, EIS is for slightly later investors, but not too late, if you know what I mean. There's thresholds. I won't go into the nitty-gritty. And you can put money in, and then if for any reason it doesn't work out, there's some protection against that from a tax write-off perspective. For that. Once a company gets to a certain growth level, that's no longer available, and then you're just buying shares as normal. And normally that would either be a grant from the if someone's trying to do a fundraise, you don't have any wealth protection in that at all, or they're going to list, and if they list, then you can buy shares in that company. The pros on it are, you are effectively benefiting from the value that somebody else is creating. That's technically what you're doing. You are the funder. You are, and you get benefit. Again,
you're
from
quite passive, aren't you? You're sort of just putting money in and just you want them to do.
Yeah, well. And slightly different to the index fund, depending on the time of your investment, you can get more out of it, if you know what I mean. If you're timing, it's not as passive. It's not as passive to make that work for your benefit in the same way. I mean, there's some companies that you could link onto and probably leave for a while. You probably want steady based companies rather than fluctuating companies. Recently in 2024 25, a lot of the companies that were doing really well in AI, but not just in AI development, but in the provisional support of AI companies such as Nvidia and companies like that who did a lot of the graphics cards that are needed.
Their stocks have exploded the last few years.
Well, they did, and then obviously China came up with a better, faster, cheaper version, and so on. And then we're now in a trade war, and a lot of it's to do with these types of things. So, and that is the pros and the cons. The pros are you can if something explodes really quickly as a company, then if you buy in early enough, then your share value can go up really, really quickly. Much more than an index
really high returns.
Much more than an index link. The negative is you are linked to the success of that company. So if it goes pop and reduces to zero, you lose all
the money basically.
And there's quite a lot of schemes you can do, like marketplaces that you can go and buy investment shares, seeder shares and stuff like that companies are just doing like a crowd-funded seed round and stuff like that, like a raise. So I think you've done the same, haven't you? So some of the companies that are associated with us. So I've got a few thousand in these types of companies, and some do go pop. They do.
And I think the thing with that is like unless you really know and understand the company, it's a bit of a gamble, isn't it?
Yeah, and people robo-invest in those things as well, a bit like they do in the index links, where they're just sticking in money all the time, and then they're just like they're putting in, they're obviously spreading the risk, but they're putting it into each company or whatever. But then I see some people putting in large chunks into companies. I'm like, oh wow, they must really believe in that company. And so I had like an electric scooter company that went bust, and a competitor to Airbnb that went bust, and so on and so forth. But then I've had really, really successful ones, like a bridging lending company that's going really well, and then I've made money from that. And then there's so all in all, I am up across those seeder ones. I also have investments in companies as well. So we founder invest in certain companies. And they have to have really tangible targets. But if you're doing that, then you are you're not necessarily that passive. You generally have a role of some
into
description.
The business. But I think also investing in individual companies. Like you can be quite passive, but if you want to do it well, you should be doing quite a bit of research and understanding of the companies and things like that. So you might spend a lot more time doing that sort of stuff. Yeah,
especially if we're still at founder stage. If we're still at founder stage, then you probably want to be a bit closer to it, depending on the value you put in.
Like Warren Buffett, example, he talks about like he invests in companies that he really knows, understands, and that they have like a competitive advantage in the market. That's why he goes into those companies. So, but he spends loads of times obviously researching and reading and
I'm not Warren Buffett.
Like that. So it's quite passive in the way that you're not running the company, but it could be more active that you're doing a lot more work to make sure you're investing in the right businesses because of the risks.
And then you've got your standard company shares, which you can buy on the stock exchange, right? So a company lists what tends to happen is the company lists on day one at here, goes down a bit, then goes up a bit, right? So it's a bit like, depending on where they are in it's called bull and bear, conditions for that particular company, their market, so on and so forth. Some are very steady, and you can actually, if you buy companies that, as an example, if the company is a holder for like a precious metal, which I know you're going to talk about as an example, you can actually gamify the system a little bit. So you can use puts and calls on, and options on shares and so on, where you can sell them off, or you can buy them. You can sell options over your shares, and you can charge option fees and so on. If you really wanted to get into that, that's good from a cash flow perspective as well, rather than a wealth generation. So putting puts and calls on a share option as an example is a good way to generate monthly cash flow. If you're going to continually invest in that, that's a strategy that people do. I know there's a guy, the successful trader Jeremy Downing, who does some training on that.
Yes.
There's some other people who do that. There's some people who've developed bots who can do this for you as well.
So good people that can educate you there, and you can learn.
Yeah, it's important to get educated, because that isn't passive. You're every day doing something on that, because you've got to identify the opportunity, sell the option, wait for the option to be exercised, and then sell your share as an example. But yeah, I mean, the traditional way of investing in a company is the stock market, invest in a company, hopefully it grows, and then exit at some point in the future. It's not really, they're not really dividend paying necessarily, unless you buy a dividend share. You are in for the success of the property, and then you can withdraw at some time in the future.
That's maybe one of the hard things, is like, what's the right time to sell those shares in the business?
Well, and this is the thing that the most successful people will tell you, is that it could go, my right time was at 200, it might go to 10,000, and people might look at that and go, oh, you shouldn't have sold at 200. Well, when you do that, but if I do that 200 times at 200, I'm way above my 10,000, right? So exactly. And out of that 200, only one of them got to that level. So it's about playing the game a little bit, and a little bit of diversification is still a requirement. I mean, if you're doing the founder investment, the angel investment, that kind of stuff, then obviously you're doing much more due diligence, meeting the founders, seeing deal packs and so on. But generally speaking,
seeing the business plan and all those.
Yeah, and you'll probably get updates directly and stuff like that, and from the founders and stuff. But yeah, so there's various ways of doing it. There's the front end, and then there's when it's listed, or there's doing it like as an event.
So just to round out the stocks and shares section, there's actually tax advantage in the UK, because you can set up what's called a stocks and shares ISA, which I think is the yearly allowance at the moment, 20 grand or something like 20, that. 20 grand. So you can invest 20 grand tax free, basically, and all the earnings you get from that are tax free. So that's another advantage in the UK. Obviously it might vary country to country as what it's not
ideal. Not ideal from a you can also do your pension in it as well, by the way. Do your pension in stocks and shares. It's not ideal if you wanted to do it on a bigger scale. It's not ideal if you want to do it with cash flow. So necessarily, because you don't draw down from that.
It can build your wealth. So it's good for building wealth, and like we said earlier, compound your wealth. But not so good at giving you monthly cash flow.
It's very much in the future profit and asset classes rather than cash flow classes.
You're best looking at it, especially index funds, looking at it for the long term and building your wealth, isn't it? Yeah. Sounds good.
Yeah. So the con is always you could just lose all your money, ultimately. Cool. So let's talk about it, because I know you have and I haven't done this. Precious metals, pros and cons.
Yeah. So with precious metals, I would say this is predominantly, say, gold and silver, like physical gold and silver. The way I look at it, it's like a defensive investment in a way. And it's also like a hedge against inflation, because it's not linked to the pound or any fiat currencies. So
you say that, but when the currencies go down or the share prices go down, gold goes up. So it's like counterlinked almost.
That's why it's a protection. Because it's like or when inflation's high, it can protect you against inflation. But generally it does almost the opposite of your index funds and things like that. So I haven't checked it, but probably the last few days, maybe the price of gold and silver has gone up.
Risen, it has risen,
if you're looking at like a balanced portfolio, you might want a bit of money in precious metals to protect against those type of events. It's good to balance it out. And I think with gold as well, if you think there's a limited supply in the world, there's a decent amount of demand for it, so that also pushes the price up. Also, it's not like your bank account. The banks can't just take your money. Like if you've got gold, it's physically yours. Some people just bury it in the ground and hide it and stuff like that as like a protection of their wealth as well. So I think there's some of the benefits. The cons are like, it's not going to give you huge returns year in, year out. You probably wouldn't, on average, make as much as an index fund or, some of those higher returning investments, but it's just a good defensive mechanism for volatile times and stuff like that in the stock markets mainly.
Again, we'll probably look at the profit and assets area, aren't we, really, for future withdrawal of that.
Other advantage, similar with stocks and shares, it's very liquid. So if you've got money in stocks and shares or gold, you can literally, if you want to sell, you sell pretty much on the day. You'll get
listed stocks and shares.
Yeah. Listed stocks and shares. Yes. Yeah. So if an index fund is an example that we talked about before, you can sell that on the day you got your money.
Yeah.
Gold, silver, pretty much on the day or, very quickly you can get your money back for it. So it's quite liquid.
Yeah. So if you're linked to an exit on a company, either because you've done an SEIS or EIS or you've invested as a angel founder, then
that could be slightly.
That
is different. Yeah, very good point.
But that could be a better multiplier. You only need one of those to go global, and all of a sudden you're in.
Yeah. So if you, and then we'll talk about in a second. But property, if you're selling a property, it can be fairly slow as well as comparison to get physical money, liquid money in your hand. So that's where, precious metals, another benefit as well.
Yeah. Better than keeping money in the bank.
Yeah.
Yeah.
Well, that's what I was saying before is like, the bank actually lends out, I think 90% of everyone's money. So if you go to, you want to physically get that money back, you might not be able to.
Yeah.
Especially if lots of other people are trying to do it as well. And they ask you questions like, why do you want your money? What are you going to use your money for? They ask you all these questions to see if they release it. Whereas if you've got gold and silver, even if you're holding it in a vault, they don't ask those questions. They'd give it back to you. Or
it used to be, and I'm not sure the currency works this way anymore, but it used to be the notes that we dished out as cash were only promises to pay the bearer off. The sentence was literally on the note. It said, we promise to pay the bearer off on demand.
Yeah, exactly.
So I say, okay, on demand, pay me the £5 of gold or whatever it is that you've given me.
Yeah, exactly. And that's where gold and silver and precious metals do differentiate as well.
Yeah.
Right. Next one, then I'll put it back to you. So asset class number 4. So building or buying a business.
Yeah. So I think they're two very different things in like building one and buying one, or you can.
Yeah. So building one, you're the founder, aren't you, in a way? Yeah.
Yeah. So we have businesses that we've built. Our property business is a property business. Our development business, our lettings business. And obviously, if you're building a business, then it depends on what you're doing it for. So if you're doing it for provision of services, as an example, and you are the service provider, then tends to be it's for your own cash flow. It's your job, basically. So if I am a one-man band providing a service under a limited company banner, that's not really a wealth building thing. You are literally trading your time for money, and that's the opposite of what wealth building is.
You're under a company wrapper.
Yeah.
But like you said, it's just you doing a service.
Yeah. And there's lots of those types. And there's nothing wrong with that. Don't get me wrong. I mean, I have got a management company myself that I built.
Yeah, and the benefits are you're self-employed. You don't have a boss or whatever and things like that. Yeah. So there's still those sort of advantages. Yeah.
Yeah, totally. But if you're going to build a business for with any value, and that's what we'll probably talk about more here, and you want to be paid more passively, and you're starting from scratch, then you're going to go through, a period of time where it's probably just you and one other. Yeah. I mean, we were sat in a little room in.
Yeah, we started that with PPB and Investment.
And you set out your business plan.
Me listening to your weird ideas to start with and going,
how's that going to work?
How's that going to work?
Yeah. And then I said, look, at some point you just go, trust me, it's going to work. And then it's just about finding your niche within that business area, because what you want to do is you want to be building. If you're going to build a business, you want it to be a business where you can retain a high net margin. Yeah. Right. So, and the way that you.
Well, it depends what your goal is, doesn't it? But
Well, we're talking about wealth building, as a business, really. So, I mean. It doesn't. So if you're going to build a business which is worth something, then you're either going to build it quickly, or you're going to build it slowly, or you're going to build it lifestyle. So I'm talking more on the lifestyle, but also has a value at the end.
Small to medium-sized business, leveraged enough that you could say exit or sell in the future, or you could keep it and enjoy the life you want, but make a good margin from it and provide high value for clients.
Yeah, I mean, if your entire plan is to exit in year 5, as an example, you set that goal from day 1, then what you'll need to do is you need to spend, grow, then cut down all costs, get into a normal operating procedure. Yeah, have at least 1 to 2 years worth of accounts of stability, then sell. So that's the kind of like that can generate good wealth, and you can have used leverage and money for that.
But then
there's risk.
I've heard lots of people say that even if you're not intending to ever sell a business, it's good to build it in a way that you could sell in the future.
Yeah,
because it forces you to get the right team involved, the right systems and processes.
That's a great
those
point.
Sort of things.
So my impact. So I was from a corporate background, and basically I had to have a look at myself in the mirror. So I'm just running business for other people.
Yeah.
Right. And other people are benefiting from it and paying me a salary. And when you look at the upside of the EBITDAs of the company and the profitability of the company, they're realizing that profit.
Yeah.
Right. I'm not.
Yeah. Yeah.
So at that point, it's a bit like, well, actually, it's worth those hard yards in the front end to systemize it and then to leverage other people's time to them who might want to work for you, to run the systems and the operations in the business, to build something where it no longer costs you lots of your time.
Yeah,
right?
yeah.
And at that point, your business naturally, if your objective is to, well, I don't want to work full time in my own business.
Yeah, so either way, you're creating good lifestyle for yourself because you've leveraged out the work and you got the systems and processes.
Yeah, yeah.
And also you're adding potentially an asset value that you could sell in the future because it doesn't rely
it's not relying on the founder.
It's not relying on the founder to run it.
Yeah,
very different to your one man band.
Yeah, exactly that. So if you're going to build a business, then
luckily we've got some team members so we can sit down and do these discussions.
Yeah, and they won't listen to this. In fact, if you listen to this, and you can say, Phil, I listened to the podcast, and the word is potato.
Potato, yeah. Send in the WhatsApp group that we've got.
Yeah, first one to do it, £100 Amazon voucher.
£100 Amazon. There we go. Team members for people who invest.
Yeah.
It's up to you.
But the thing is, the people that listen, it just demonstrates the people listening are not necessarily the people that you would employ or engage. Right? Yeah. It's more to do with the people that are looking to do something differently. Because there's nothing wrong with having a job, right?
No.
It suits people. I mean, if you can go home at night and switch off, right? That's a real benefit in life, right?
Yeah. And that can be one of the challenges as a business owner, an entrepreneur, is that you do have responsibility.
And that is what you're making is a sacrifice. You as a business owner are no longer 9 to 5. You are 24/7, right? And you are going to think about things on Saturday, Sunday, which regardless of how good you are, right? So
even if you're not physically doing it or actioning, it's
it will creep into
your mind.
You can't not have it. So that's a big con of building a business from day one, is that the flip side of it is buying a business, or so buying a business.
We're buying an existing, relatively established business. So
there's lots of people who do this really, really well. I haven't done it, but it is on my radar of, this is probably the next venture for me is to do this. And it's very much about asset management. It's about buying a business and seeing how profitable we can make that business, and then making a profit from that. Yeah, right.
And maybe making it better, improving it with
systems, that you have
operations, that the previous owners don't have.
Yeah, exactly. And quite often you could buy businesses that might have property in it or something like that. That could also protect your investment, and that's always a good thing. If a business has been running for 10 years with steady profits and has an asset that you can also buy, what a great purchase. It then comes down to the price you can buy it for, right? But I mean, it depends on the multiplier that you have to pay for that.
Yeah, and I know, I hear people talking about at the moment, there's some big opportunities because a lot of, I don't know the percentage, but a big percentage of lots of businesses, say in the UK, are owned by the baby boomer generation.
Yeah.
And what do they want to do? They want to retire. They've had enough.
You can also
they don't, they either want to wind down the business or sell it at a reasonable price, so they don't have to wind it down. And
and depending on the deal and the profitability of the business, you might be able to even tie in, like as part of the earnout, that the business pays for the earnout.
Yeah,
if you know what I mean. So it doesn't actually cost you this. You might be able to, depending on the profitability of it and how well managed it is, you might be able to raise funds in the business, maybe take a small bank loan into the business that can be easily demonstrated as funded by the cash flow, pays out the investor, they get an earnout from the profit as well, and then once they're gone, your cash flow and profit goes up. But another smart strategy is, if your business is doing really well, and you've got it really well operated, systemized, is just go and buy other businesses like yours.
Yeah.
Right? And go and talk to other founders like yours who might be wanting to exit, even when they're still at a smaller scale.
Yeah.
So you can bolt onto your business, or even if it provides a similar service or a complementary service.
Yeah.
So if you think our business is sourcing project management and lettings. Like a lettings part could buy another lettings business, systemize that, and just take on the cash flow and the element and the revenue,
and use the systems that are used
and improve the systems and even provide a better benefit to those.
And that adds value to the overall business as well.
Yeah, exactly. So you can those are smart things to do. I think this isn't a passive environment though. Just so I'm clear. You have to be really smart and get in the mix. Even if you're buying existing businesses and you want it to be managed, you are going to have to act as the CEO, make some good decisions.
And if you're a director, you do have that responsibility, don't you?
Yeah, don't walk in and put your size 10 in on day one and disrupt everything. That's a nightmare.
Yeah.
All the staff leave because they think you're a moron and stuff like that.
So I think also where this differs from, say, your precious metals and your stocks and share investing is that owning a business, as long as it's profitable, you're bringing money in each month to your pocket. So that's cash flow. And then potentially you're building an asset value, because if the business has a value, you've got an asset value that you could sell in the future or whatever. So it's that combination of building wealth and getting cash flow, isn't it? In this sort of scene. Yeah.
Yeah. And it's probably the fastest way to build a comfortable cash flow, to build a business. And if you do a business like we do, we've built the business in what we do to build our investments, then that's very smart.
Yeah, and it complements each other because, we do the business, we make profit, we reinvest that in property and stuff like that, which we like. And
it's become self-perpetuating.
Yeah, absolutely.
Stop the podcast now. This episode is sponsored by Property Filter. Property Filter is the #1 property tool for today's property professional. It brings in all the data points and sources from all the property portals and auction sites into one convenient place. Then you have the option to overlay all the clever strategies found in the Property Filter blueprint to find motivated sellers faster. Now, we use it on a daily basis. It saves us over 80% of our time when looking for properties. And if that sounds like something that you want in your lives, please go to register.property-filter.co.uk/PPB, which is the discount code for this podcast. You will get 2 weeks free and a discount on your first month. That's it from me. Back to the podcast.
Okay, so question 5, self-generating question. Property, pros and cons.
Property. So we won't go into too much detail because we talk a lot about property in this show. But you buy a property. The advantages are that you build wealth from it because property prices historically double, I think, on average between say 12 and 15 years. So there's the investment value that goes up over time, especially if you're investing for the long term. And then also by having a property that you rent out, you can get cash flow in your pocket from the rental return minus the cost every month. So you get a combination of cash flow in your pocket and investment for the long term. Just to add to that, the other real reason from an investment perspective is that you got things like banks. So you can get leverage there. So, for an investment property, the bank will lend you, say, 75% of the value and you get all the benefit from that. So it's leverage as well. So a combination of those three key things are like the advantages for going into property.
Yeah.
It's not so...
I think it's the only asset class you can get both, isn't it? I think in terms of really get both cash flow benefit and equity benefit.
Relatively passively as well.
In almost an even way.
Yes.
If you know what I mean. So if you're getting 7% yield cash flow, you're getting 7% equity. It's actually 14% year on year.
Well, actually, if you say 77% equity, and you've got 75% loan, your percentage equity jumps up quite a bit, doesn't it? If you owned it straight out in cash and it was going up 7%, you're making 7%, getting 7% cash flow. So that's 14. But if you leverage your wealth on cash, or that 25% might be, say, 23% or something like that. And you're also making, say, a 7 to 10% return. So it jumps up.
Yeah, because your mortgage is static, is what you mean. See, all the benefit on the property growth is yours.
Yes.
Yeah.
And also, when you compare it against inflation, inflation actually squashes debt. So even if you keep your mortgage at, say, the same level, because you want the cash flow and you don't need to pay it down, inflation naturally squashes that debt over time, doesn't it, as well?
Yeah. Unless it's like a bang.
Yeah.
Donald Trump just decides to press the button.
So then I think, exactly. So some of the cons then for property. So I think a bit earlier we talked about liquidity and how quickly you could get funds if needed. Property, especially in the UK, it's not it's not that liquid because you got to put it on the market to sell, and there's a legal process and conveyancing and stuff like that. If you're selling it with a cash buyer, it can be quite quick. If you're selling it to a mortgage buyer, it can be quite long. Sometimes there's chains and things like that involved, so it can be longer. So that's probably one of the cons. The other con is it may not, it's fairly passive. Depending how you manage it and look after it, there can be a bit of hassle with tenants and things like that, rent arrears and all those sort of things or challenges that come up. So that's potentially one of the cons if it's not managed effectively.
Yeah. I think in the grand scheme of it as well is like people look at property as in one thing. It's like, oh, it's like if I said to me, oh, you need to buy, I'm going to become a property investor now with like Dave off the street, then sorry, I don't want to pick Dave. Dave's a perfectly good name, by the way.
What's wrong with Dave?
Nothing. Then he's going to think, oh, I'll just buy a house and rent it out to somebody. Yeah. Right. But there are lots of different strategies
in property different strategies
that you can do, and some of the smartest ones are trading or like commercial property or all those sorts of things that actually are very smart strategies that you can have in very top end asset classes that do you really, really well.
Absolutely. We'll listen to some of the odd podcasts we've done, such as the strategy episode we did.
Oh yeah, of course.
Ago, which can help with that.
Yeah, absolutely.
Right. So the last one then, round 6 of our asset classes is cryptocurrencies. What can you tell us about them?
It's the world's biggest Ponzi scheme, right? So, and I don't mean that.
Obviously, this is opinion based. I think we do need to also caveat this is not financial advice.
Yeah, no, none of this is financial advice. Yeah,
it's just things that our opinions on the matter.
Now, crypto is obviously it's the fastest way to generate wealth and the fastest way to lose everything, right? In the moment.
Very volatile. Yeah. Obviously, it's gone up. Like if you took Bitcoin example.
Yeah. So and there's various things within crypto, right? So it's developed. So there was a big thing a few years ago, which was like digital imagery, that you could buy and stuff like that. What was that called? I can't remember it. It's like NGOs or something that you could buy or something like that. I can't remember the name of it, but that came and went really quickly and people lost a lot of money.
There's lots of coins that have come and gone, haven't there?
Yeah, and then there's things like meme coins, which are basically fun coins that people can invest in. And then, depending on who backs it, goes up really, really quickly. And then because it has no tangible value, it goes pop. And then there's the traditional, crypto environment, which is if I went back 20 years in time with £1,000 in my pocket, I'd be handing it to my younger self saying, buy that Bitcoin thing that everyone's dissing, right? Because at the time,
and then the question would be, when do you sell it?
Exactly. So at the moment, so when I say, I use tongue in cheek when I say it's the world's biggest Ponzi scheme. So a Ponzi scheme works, put money in the bottom, it increases the money at the top. Okay, so there's no tangible benefit in the medium, right? So
there's not a lot of real uses even for Bitcoin, is there?
The only real value is that people believe in it and they keep putting money in.
Yeah, and, and I know a lot of...
So before we move on to a coin, that's generally what a Ponzi scheme is. And then eventually what happens is the confidence in the product stops, or they can't generate enough new sales, which means that it's not giving the return enough, or it stops growing. And all of a sudden people want out. Nobody else is willing to do it. There's loads of media and furore about it, and then it goes pop. So there's a guy who's just gone to jail, right, in America or something, who actually had one of the real top coins,
right?
That he was specifically that, and it was deliberately that as well. Like he didn't have any of it.
Nothing now.
Yeah. So the difference is like some of them, like Bitcoin and a few others, have tangible uses. Yeah. So you can trade with them, you can buy stuff with them, you can do these
some uses,
And originally it was set up to support the blockchain, right? Which was a whole thing, which is the blockchain was supposed to, right? Say the whole point of blockchain is if I am producing something in the UK, which is highly sought after, like a phone as an example. Then I am buying my parts from X, Y, and Z. I don't want to get slowed down in all of my supply chain. I want to push a button here. And I want all the micro transactions to happen. So I'm going to put my coin in at the front end to say, this is how much I'm going to buy this product for. And every supplier along that chain can get instantly paid by taking a portion of that coin.
And there's no central bank control.
There's no central bank control. And then at the end of it, you can trade that back into the liquid currencies and things. So I do think it's here to stay, crypto. I don't think it's a Ponzi scheme anymore. But I think people can use it as that, and that's why you need to be really, really careful. Where will it stop? It will only slow down if people stop putting money in.
Yeah.
And when will that happen? You do not know. It's like economics is driven by the front news page of the newspapers, right? And the websites. So if everybody turns around tomorrow and says crypto is dead, it was a Ponzi scheme all along.
Yeah.
Sell quickly, then what's going to happen to those coins?
It could go to zero, couldn't it?
Could go to zero. Yeah, absolutely. Because there's no tangible value and you can't sell what it's worth anymore. So,
and then if there is confidence in it, I think one of the pros for it is that there's limited supply in the market, isn't it?
Yeah.
So,
and that was very smart,
yeah,
by the way, because they only produced a certain amount. That was very smart, specifically on Bitcoin's behalf, which was I only make, I think it's like 33,000 or something. I think the back of my mind is the number of 30.
Yeah, I can't remember the amount, but there is a limited supply, isn't it? So,
yeah.
So they say people in crypto say, "Oh, it's simple demand and supply." I'm like, yeah, okay, as long as it's
So that's very smart because you're only ever selling a portion of the existing.
Yeah,
if you know what I mean. So
you can't just print it. It's like it's not like money. You can't just print it.
Yeah,
it's there's a limited amount for. Bitcoin.
Yeah, so if there was a limited amount on the top tier of this scheme, as an example, and all you can ever do is buy a portion of it, then that does give some wrapper of protection for a period. But whether or not it's a tangible thing in the long term will all depend on how easy it is to use in the real world. It won't be probably not in our lifetime, but if you fast forward 50 years from today, maybe in my lifetime still, but in 50 years from today, unless crypto has a tangible use, I can't see it still growing at the same rates. So at some point, people are going to stop putting money into something that has no tangible function. If all it is an investment platform, then it's completely reliant upon what goes in at the bottom end.
So even at this point, so I don't know how long is Bitcoin been around, say 10 years, something like that?
A bit longer than that, I think.
Yeah. I personally, I still see it as what you call a speculative investment. So like the companies were saying before that like they might go really well, they might go bust.
Yeah.
I sort of put it in that category.
Yeah, same.
So it's not saying don't ever do it because obviously it could keep going up and up and up, and especially if that use comes to fruition, could really make huge money out.
Yeah, and you
have to understand the risk.
It does have some tangible uses, and if you follow any crypto guru, they will tell you about all the tangible uses for Bitcoin. I'm thinking that's great, but not at the value.
Yeah, not the value it is.
That it is.
Yeah,
the tangible use would be probably 1/1000th of its existing value.
Yeah.
So yes, it has a tangible use, but only to that 1/1000th or something. In that case, then it's still completely reliant upon that bottom end capital input. If it gets to a position where it's no longer reliant upon that, then great.
So a responsible thing is like looking at these asset classes, and if you want to get involved, maybe look at a smaller percentage or something like that is maybe a responsible way to look at it.
If you want to have a bit of fun with crypto, then I would say that's a good place to be. Would you bet your house on it? Probably not.
Yeah, and I know there are a lot of people in crypto that everything goes into it, and it's might really, really pay off.
Good. I'm happy to be proven wrong.
Yeah. So watch that space. Watch.
Yeah, no, definitely. Yeah. This isn't financial advice. I am limited in my knowledge, so I did research it because I was looking at it myself.
It's definitely not my expertise or anything.
And I couldn't find
a little bit on it, and that's it. So
I couldn't find a tangible reason for the majority of the coins.
But sentiment does affect the price, doesn't it? Because I remember I listened to, I think it was Diary of a CEO podcast with a crypto expert.
Yep.
And literally, as soon as that podcast released, the price went up.
Because he'll have told them why it was so great.
And he was even talking about the ones you should go and buy, how much you should put into it, platforms to use. So I don't know if they qualified the financial advice, but he definitely was giving financial advice in that podcast. And the price just went up.
Yeah, obviously the coins are available.
Yeah.
So, but no, I mean, my advice is don't invest in anything unless you're absolutely certain. Obviously, I've lost money, I've made money, and you've got to everything carries risk. None of this is financial advice, but these are all asset classes that you could look at. Yeah. There are other things that you could look at, but I mean, these are the main ones that people talk about.
These are the main ones, and as assets go, there's not a huge list, are there? There's not a lot of things that fall outside of those 6 categories, are there?
Really, no. Well, what's really smart is you can do stuff like you can mix some of the asset classes.
Yeah.
So I won't go into it in great detail now, but you can buy stocks and shares in businesses that own precious metals.
Yeah, like gold mining companies and stuff like that.
Well, it's just holding companies, gold holding companies that you can have. So you can do things like that, which are quite smart. But I mean, it's
shares in like property businesses and things.
Yeah, exactly
like
the same. Old commercial property businesses. Yeah,
they've got funds for that sort of stuff. So you can.
Buffett's in. I'm in. kind of thing. Just follow what Warren Buffett does. You could do that.
Well, I'd be interested to see what he's done today.
Yeah,
I know he became very liquid recently. Well, the last few years he's become very liquid in his business.
Yeah.
Obviously, knew what Trump was doing or whatever, and
I think he'd probably be buying, mate.
Interesting to see what he does over the next 6 months.
I think his philosophy was be greedy when others are fearful.
Yeah.
And be faithful when others are greedy.
Yeah, so within the last few days, people have been selling their funds, selling their shares.
He's probably buying
and he's been getting ready to buy. So he's just smart, isn't he?
He's just a smart guy, yeah.
Very smart guy. So see what he does over the next 6 months.
Yeah,
I think.
Yeah, ignore everything we've said and just go do it one. Good. All right.
That rounds it out. 6 rounds of asset classes to achieve your financial freedom.
Yep.
And we'll see you on the next one.
There we go.
Thanks very much.
Thanks very much. Bye for now. Thank you once again for joining us on the Financial Freedom Podcast, sponsored by us at Property Portfolio Building. If you want to get in touch with us about today's podcast or any of the learning topics that we've gone through today, you can email us at podcast@invest-prop.co.uk or get in touch with us with whichever your social media platform of choice is. If you think you would add value to us as a guest on this podcast, you can please get in touch and let us know what you would be able to talk to us about. Other than that, we wish you well on your financial freedom journeys. And once again, thank you for joining us, and we'll see you on the next one.